The recent spike in crude oil prices has again exposed India's vulnerability towards oil prices. Unfortunately, we still import 85% of our oil. And when crude oil goes up, everything becomes expensive. Now, the deeper issue here is not just high oil prices, but lack of control. Oil is globally priced, heavily influenced by geopolitics, and extremely volatile. So every time there's a disruption, whether it's a war, supply cut, or geopolitical tension, India effectively ends up importing inflation. That's why crude oil spike often feel like an energy crisis in India. Not because we suddenly run out of energy, but because the cost of energy becomes unpredictable and difficult to manage. So the real question is, how do we reduce this dependence? And this is where electricity becomes extremely important. Unlike oil, electricity can be generated domestically using multiple sources like solar, wind, hydro, nuclear, and even coal to some extent. Which means, over time, if a larger part of the economy shifts from oil-based consumption to electricity-based consumption, India's dependence on crude oil can structurally reduce. If you think about it, this transition is already visible. Electric vehicles are replacing petrol and diesel consumption, railways are getting electrified, industries are gradually moving towards electric processes, and even at household level, there's a slow shift towards electric alternatives. So the direction is clear. More and more economic activity is moving from oil to electricity. But this transition comes at one big condition. Electricity has to be reliable, scalable, and affordable. Because if power supply is inconsistent, industries cannot depend on it. EVs adoption slows down and consumers fall back to traditional fuels. So the real shift is not just from oil to electricity, but from oil to a reliable power ecosystem. If India wants to reduce its dependence on crude oil, it has to build a strong integrated power system that can support this transition at scale. And one company that is building India's power ecosystem is Tata Power. That's where in today's video we'll deep dive into Tata Power business model, the latest developments, future growth plans, financials, and then we'll assess the valuation. Because it's been 2 years since Tata Power share price has been consolidating. And finally, we'll look at the key risk in Tata Power's growth thesis. Alright, let's get started. Let's start with the phrase that you will hear a lot. Vertically integrated power company. Most power companies do one thing. They generate electricity or they distribute it. Tata Power does everything. Its portfolio spans the entire power value chain from renewable and conventional energy generation to transmission, distribution, energy storage solution, solar cell and module manufacturing to EV charging station. Now this slide gives a clear high-level picture where Tata Power has a total of 26.3 gigawatt of power generation capacity that include both operation and under construction facility. Within this, 17.5 gigawatt is clean energy generation, including 10 gigawatt under construction, and 8.9 gigawatt is thermal energy. Then company has 4,738 circuit kilometer of operational transmission line. 2,573 kilometer transmission lines are under construction, and company has 13 million customers in distribution. Then within the new age energy solution, Tata Power has 4.9 gigawatt of integrated cell and module manufacturing capacity, 2.8 gigawatt of MOU signed for pumped hydro projects, and 5,743 public EV charging points energized across 667 cities and towns. Now this slide gives a clear breakup of power generation. At the moment, 16.3 gigawatt of power is operational. Out of this, 54% is thermal power, followed with 27% solar and remaining hydro, wind and so on. Their current power pipeline is completely green. So total capacity including pipeline would be 26.3 gigawatt, out of which 34% would be thermal. So thermal power will fall down from current 54 to 34%. Solar would contribute 20%, followed with hybrid, PSP, that is pumped storage projects, hydro and so on. This slide gives a good roadmap on how Tata Power is transitioning from thermal power to clean energy. In 2015, thermal contributed 80%. In 25, its contribution is 56%. In 2030, it would reduce to 30%. And finally, by 2045, Tata Power intend to become a 100% clean energy power generator. I hope you got a fair idea on why Tata Power is a vertically integrated power company. Now, as far as revenue model is concerned, Tata Power earns money at every stage of power value chain. First is power generation. They produce electricity, thermal, solar, wind, hydro, and sell it under long-term contracts, that is PPAs, or in the open market. This gives scale and steady revenue, but here margins are moderate. Second is transmission and distribution. They supply electricity directly to consumers in cities like Mumbai and Odisha. This is a regulated business, so tariffs are fixed and cash flows are stable and predictable. This is actually the backbone of their earning. Then third is renewable ecosystem. It includes your solar projects, rooftop solar installation, then EPC work and manufacturing. This is the growth engine where revenues are scaling faster as compared to traditional businesses. And then there are smaller emerging areas like EV charging and storage, which are not big contributors yet but can become future revenue drivers. Now this slide gives a good breakup of revenue and EBITDA. In Q3 FY26, company generated a revenue of 14,500 crore. Out of this, 2,000 odd crore was from thermal, coal and hydro. 3,785 crore was from renewable and a massive 9,600 crore comes from transmission and distribution. EBITDA wise, out of 3,900 crore total EBITDA, around 2,000 crore is from transmission and distribution, around 1,600 crore from renewable and remaining around 300 crore is from thermal. Now if you look at company's financials, its revenue has doubled in last 5 years and net profit has jumped 3 times. Although trailing 12-month growth has been subdued. The catch is, due to heavy capex business, Tata Power return ratios are not very exciting. Although cash conversion has been exceptional. Now let's look at the future growth driver and company's growth plan. So the first and most visible growth driver is renewable capacity addition. Tata Power has a strong pipeline of solar and wind projects and the strategy is very clear. Increase the share of clean energy significantly over the next few years. Then second growth driver is solar ecosystem, especially manufacturing plus EPC plus rooftop. Tata Power is not just developing solar projects, it is trying to control the entire value chain. With expansion in cell and module manufacturing and future plans for backward integration, company is positioning itself to benefit from India's push for domestic solar manufacturing. Along with this, rooftop solar and EPC order book are scaling up, which can drive higher revenue growth over the next few years. Then third driver is distribution turnaround and expansion. While distribution is a stable business, there's still growth coming from reduction in power loss during transmission, better billing efficiency and increasing demand in licensed area. Especially in Odisha, performance has improved significantly. That has resulted in 207% growth in PAT in 9 months of FY26. Then fourth driver is energy storage and grid solution. As renewable penetration increases, storage becomes essential. Tata Power is already working on battery storage and pumped hydro projects. This is still small today, but over time, it can become a critical layer of energy ecosystem and potentially a high-value business. Then fifth and more long-term driver is the consumer-facing energy platform. It includes rooftop solar, EV charging infra, and energy as a service. This is where the model shifts from just selling electricity to managing energy consumption. If executed well, this can create a sticky, high-margin business over time. Company has installed 1 gigawatt of rooftop power in 9 months of FY26 with strong order book of 1174 crore. Now let's try to understand the key risk in growth thesis. So the first and most important risk is execution risk. Tata Power is trying to scale multiple businesses at the same time. Renewables, solar manufacturing, rooftop, EV charging, storage, and so on. Each of these require different capability. If execution slips in even one or two segments, whether due to delays, cost overrun, or operational issues, the expected growth can get pushed out. Then second risk is high capex and balance sheet pressure. This entire transition is very capital intensive. Building renewable capacity, setting up manufacturing plant, and investing in storage. All of this requires significant capital, which means higher debt, higher interest cost, and lower near-term return ratio. So if cash flow does not scale up in line with investment, it can put pressure on profitability. Then third risk is policy and regulatory risk. Power is heavily regulated sector, whether it's tariff, renewable policy, import duties, or distribution rule. A lot depends on government decision. Any adverse change in policy can impact the returns. Then fourth risk is competitive intensity. In renewables and solar, competition is increasing rapidly. Players like Adani, NTPC, JSW, and even new entrants are aggressively bidding for projects. This can lead to lower tariff, margin pressure, and aggressive capital allocation. Then fifth risk is legacy thermal exposure. While Tata Power is transitioning towards clean energy, it still has a meaningful thermal portfolio. This thermal segment has limited growth and can face cost pressure that may drag overall return ratios. Now, this brings us to the most important question from an investor's perspective. The story of Tata Power sounds very compelling. Integrated ecosystem, multiple growth driver, strong positioning. But is the story already priced into the valuation, or there is enough scope for share price return? Let's discuss it. So if you look at Tata Power valuation in terms of PE ratio, before COVID, it used to trade at very low PE multiple in the range of 15 to 20 PE. Its price to sale used to be below 1, price to book was below 2. So that time, market was giving a PE multiple of traditional utility company. However, post-COVID, there has been a re-rating and now the stock is trading in the PE range of 30 to 35. Price to sale is at 2 and price to book is more than 3. Because of this re-rating post-COVID, its share price has jumped significantly. So the market has already factored in the transition from thermal power to clean energy. However, it's been 2 years since Tata Power share price has been consolidating and valuations have cooled off a bit. So at the moment, at PE of 30 to 33, valuations are neither cheap nor very expensive. On one side, there's a lot of opportunity in power sector. On the other side, there are certain risks including heavy capex and lower ROE. Having said this, considering the reputation of Tata Group and Tata Power's presence across the power value chain, along with focus on new growth drivers like energy storage, grid solution, along with consumer-facing business like rooftop solar, EV charging infra and so on, it is certainly a good bet to play India's power story. In the latest annual report, management has set an ambition to achieve 1 lakh crore of revenue and 10,000 crore of PAT by FY30. So if they are able to achieve the numbers, it would translate to 18 to 19% kind of CAGR growth in earnings. For that growth, current valuations are fair to consider Tata Power in the portfolio. Now, if you look at the shareholding pattern, promoter holding has been constant in last 12 quarters. FI holding is also more or less same. DIs have actually increased stake from around 14 to now at 17%, and public holding has consistently reduced from 29 to 25.6%. So if you step back and look at the entire picture, Tata Power is no longer just a traditional power company. It is trying to position itself as a complete energy ecosystem player, from power generation to consumption. And that's exactly where the long-term opportunity lies, especially in a country like India, where energy demand is only going to keep rising. At the same time, it's important to stay realistic. A large part of this transition story is already known to the market, and that's why the stock has already seen a re-rating in the past. What lies ahead is not a discovery story, it's an execution story. The company has laid out an ambition roadmap, whether it is scaling renewables, building manufacturing capability, or expanding into new energy solution. But ultimately, the real test will be how efficiently this translates into earning growth over the next few years. So if you think about it, Tata Power sits at a very interesting point. On one side, you have strong structural tailwind, that is India's energy transition. On the other side, you have near-term challenges like high capex, execution risk, and moderate return ratio. Which means this is not a stock where you can expect quick gains. This is more of a long-term compounding story where outcome will depend upon how well the company executes its strategy. And maybe that's the simplest way to look at it. Tata Power is not just a bet on power, it's a bet on how India built its energy future. So that's it from my side. I would love to know your take on Tata Power. And if you find this video useful, do share it within your circle. I'll see you next video. Till then, take care.